Hi everybody, this is Gary Dean and this is our nightly video report for Tuesday, March 15th, 2016. So really a nothing day. Old Man Dow, that's what they've really been working on to hold the markets up and lift them higher. And today was no difference. They continue to buy the Dow, and from there it seems to be, holding everything up, but we saw the small caps take a huge hit today. So, the underlying, dynamics of the market really have not changed. And what I want to go over, since there's really not a whole lot to go over with our regular charts, is some of the reasons why, I continue to say that the long side is not as safe as many are thinking, and at a bare minimum, expecting some type of 100 to 100 plus point move to the downside on the S&P has been the normal when we've seen the breadth charts at these levels. So the first one is just your advanced decline line, and just notice these blue lines here. So this is up here, this is the S&P down here. Now each time we've reached these levels, this is a 100-point drop. Obviously we kind of chopped around here, but then obviously dropped a lot more than that, and we're right back at these levels again. This is not safe. It's not, something you want to be jumping in on the long side expecting that the S&P is going to go higher. Now, does it mean that we have to go down? No, it's just saying that it's dangerous right here. Next chart we want to take a look at is the put-call ratio. And if you notice these lines, whenever it's been down here, it's been loaded with calls. We've had some kind of pullback. Now you can see the put-call ratio has actually bumped up, and the S&P has not moved at all. But again, we're at levels that you can't really relax if you're on the long side. And again, it doesn't mean that things have to drop right now. It just what I'm really trying to point out is that it's not as safe as you think. So the next one is just a bullish percent here, and again, look at when we were at these levels here, right here. It's that this caused drops, and we're right back at these levels now. Now, if you look back at these levels, yes, it hung out there, but this was a totally different time than what we're in right now. We don't have that the Fed pumping the QE into things, and it's if we're just going to follow when the market has gotten really choppy. Every time we've gotten to these levels, we've seen some type of pullback, and it's kind of what I'm expecting again. Now, the last thing I'm going to show you, this is just a commodity index, and the reason why I'm showing this compared to the S&P is this usually breaks first. So, typically we're going to see this commodity index break before we see the S&P. So we already have the moving averages that have rolled over here. You can see it's trading underneath it, and typically what has happened is we've seen the S&P follow shortly after. And the same thing is up when it goes on the upside. It usually breaks and you see the moving averages move, and and that's the way it is. So this is another thing that's saying, just be careful, because it looks like it's starting to roll over, and yet we haven't seen the S&P really follow at all. So if we take a look at our regular charts, we are going to start off with the Dow again, up 22 points, hovering this weekly moving average. If we take a look at the daily chart, what you're going to notice is that it's every day right around the close, what they do is we just see these buying sprees come in, and they hold everything up. Now, this was the drop that we had when we after the ECB cut rates, and we pretty much closed right there. But if you take just this one day away, we're going on a lot of days on the upside, and even the ones that were down, they did a lot of work to get it back to even. So we're getting pretty overextended on things, and we are trading right at the weekly moving average, which again, even if they manage to bust through that, they still have this trend line that's been in place since going all the way back to almost a year ago. So here's this. If they break that, then yeah, they have a little more room until they hit more resistance. But if this is just a triangle, the next move is coming all the way back down into these levels here. So again, just something you just can't be too relaxed on the long side. Now the S&P still has a little more ways to go, 2032, but again, is it, do you want to be buying the last 20 points? I mean, I'd rather be buying down here, and obviously it would have been nice to hold it the whole way, but we were getting mixed signals, and now, we're just kind of waiting for things to roll over. But, again, we're going on, this is the 5th week right here, and if you look at previous moves, that's been pretty much the time period before we saw the big drop, and I really am expecting the same thing to play out this time. So on the 60-minute chart, I'm just kind of redrawing this wedge because it's originally it's already broke. This was the original wedge, so we broke through it, but then we got this big move up. So I'm just redrawing it to this, but no matter what it is, it's still a bearish wedge with bearish divergences and very, very overbought right there. If they head up, we already know that we have the 2031, that is the weekly moving average. We also have resistance at this gap at 2043, and then we have a 78% retracement at 2051. So these are all levels that the bulls have to break through as we were running on, a move that has barely taken a break that lasted more than 1 day with bearish divergences. So 15-minute chart, you can see that, just a 23% retracement is bringing the S&P down to the 74. But we have this support right here at the 2069. But really the biggest thing is there's just so many gaps that are underneath here that it's just really not something that you want to fall in love with, because once these gaps and the wedge starts breaking, momentum picks up, and what happens is you get moves like this because everybody's trapped at the top. So again, not saying that has to play out right now. I know we have the Fed meeting tomorrow. I don't really believe that they're going to say anything to shock the market, but right now really the main thing the bulls have to do is, I would say, push it through this, say the moving average right here at 2,000. And if that happens, then most likely we're going to see a move down to the 1974, which will break the second leg of the wedge here. So that's pretty much it. We never really got to completely, oversold levels here. And it's, they tried to bring it up and we closed pretty much even. So that's pretty much it. There's not a lot more to go over because we're just trading within this little range. But the biggest thing is that, we've seen these up and down moves. And to me, just looking at the breadth charts and everything that's going on, I believe we're at the, the later end of this move to the upside and not really looking at a whole lot more room to go before we see things roll over. So with that, have a great night, and I'll talk to you guys tomorrow.